Hello, everyone. Good afternoon. On today's edition of The Final Bar, we'll recap today's trading, a little bit of distribution, but energy, the big winner, up big time today. We'll break down the charts of energy, financials, a lot of M&A activity and rumors that are moving things around. We're going to have a Talking Technically segment on Candlesticks, which is a good topic to revisit. Also, my guest, Todd Sohn from Strategas. Ladies and gentlemen, this is The Final Bar. Hey everyone, welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks so much for joining us today and every day after the close to break down the charts from a short-term perspective, but connect them to the long-term trends. It's really the theme of this show. It's sort of what we had envisioned, and great to hear from your feedback that you're sort of getting that message, taking a step back and measuring the long-term trends using the charts that you have in front of you. As a reminder, please keep your questions and your feedback coming. The Final Bar at StockCharts.com is the way to get any questions our way. We're going to have a mailbag session tomorrow. So if you have any questions you'd like us to consider, please shoot them to us today, and we'll make sure we take a look at them and share some of the ones on the air tomorrow. My guest today is Todd Sohn from Strategas. He's in New York. I met with him recently. I've known him for a number of years, but had lunch with him on my recent trip to New York. We talked about having him come on the show. He has some really cool charts about volatility and just an overall take on the global equity environment. So really excited for you to hear his take. We'll also do our mystery chart segment. We did one earlier this week. This one is going to be a key chart that you're going to want to be aware of. So a lot of cool things coming in the show. Let's get right to it. So the market recap today, obviously the theme we've been talking about so much since we've been on the air over the last month or two has been talking about the overall leadership environment. One of the themes was the leadership away from defensive sectors into more of offense. Then it was about, large versus small versus mid. And those themes have certainly bubbled to the top looking at the charts today. So right now, the S&P finishing about 0.5% down. We'll see as things sort of settle in at the end of the day, the NASDAQ down a little bit further. But the key message I would say is looking at small and mid caps down even further, right? So S&P 100 almost up for the day, sort of flat. Then you have mid caps down 0.7%, small caps down 0.5%. So we continue this pattern of where the small and the mid cap names are at the bottom end of the performance listing for each day. And again, that's not what extended bull markets tend to be made of. That's more of a flight away from the speculative parts of the equity market, more into the conservative ones. We talked yesterday about Fibonacci retracements. I'm going to show you what the chart looks like, but this is just looking at the last 2 days of trading. On this chart on your member dashboard page, we always show the previous day's close as just a horizontal line, just to show you, just to orient you where we're at relative to the previous day's close. And I will tell you, it's a really interesting level to pay attention to, because look, after the sell-off in the first 30 minutes, as we sort of recovered and came back, look how we came back right back to the previous highs and then sort of pulled off from there. So having an awareness of where we're at relative to the previous day's close is often just a really good short-term measure to pay attention to. Let's stretch out just a little bit, looking at the last 5 days. This is the chart we looked at yesterday with the sell-off sort of into the lunch hour. We rallied back, hit 38.2 and then 61.8% retracement and pulled back from there to the close. Now look at what happened today. We actually traded a little bit lower, came right back up to the previous day's close, which, look at that, lines up very well with the 61.8% retracement level. So the market has memory on some of these levels, and I bet if you extend the 38.2% level, that actually served as support a number of times, in the afternoon and then going into the close today. One of the things we've talked about is just that last 30 to 60 minutes. That's when a lot of institutions are making changes. You can see here there's distribution. That's a similar pattern to what we've seen the last number of days. So sort of a consistent implication that there's some profit taking happening as institutions are using that opportunity to unwind position, not to be adding new positions. But looking at the daily chart, looking at the last 6 months or so, the long-term uptrend still very much in place. We've had 3 days of lower closes, which is interesting. But again, that's not a downtrend. That's just a move, a very short-term tactical move. We still have not broken through short-term support. So this 30.75 to 30.80 range, that's really the line in the sand I would have in mind. And as long as we remain above there, this primary trend is still positive. So in any healthy uptrend, you're going to have some pullbacks, you're going to have some profit taking. That's okay. You just want to make sure that that's not an extended move that's really going to start to change the character of the markets. Looking at the sector returns today, as I mentioned, a couple of key themes to highlight here. Number one, energy rallying in a big way. This is a chart of the XLE. And again, this is just the far right side. This is looking at the last year. But if you look here, you know, sort of this pullback, the lower highs, lower lows, we've now broken up through a trend line. If I connect those highs from the last couple of weeks, you can see just today we've now closed up through that trend line. That's the first signal of some sort of short-term reversal. After the XLE had broken down through the 50-day, came right back above it. So overall, a little more positive than negative, just based on how it's now broken above trendline resistance. As we've mentioned recently, I think the 200-day is a really key barrier because that's been the ultimate resistance level for energy for a while now. So until it can reclaim that, hard to get too excited about it. Communication services and healthcare, the next two, those were the three sectors that were up on the day. Down at the bottom, we have real estate. And again, that theme we mentioned, going away from utilities and real estate into more offense, that sort of continued today with real estate down the most out of all of the 11 sectors. Both of the consumer sectors down here at the bottom. So again, a lot of times, instead of having consumer discretionary at one end and staples at the other, which is what you'll find a lot of times looking at sectors, here you actually are seeing them move in lockstep. So it tells you a little bit about the character. And consumer discretionary is a tough one because it has a lot of different things. It has things like Amazon, hotels, I mean, a lot of different luxury retail, all sort of within a sector. It's a very diverse sector, a lot of different businesses in there. Staples a little more homogenous, I would argue, but overall you can see they all are sort of moving lower in lockstep. Another key theme that we saw today, just from a news perspective, that's certainly reflected in the charts, was the buyout conversations in the financial sector, right? So we have Ameritrade being bought out by Schwab, and then you know, ETFC also sort of has a sympathy move going down with sort of E-Trade, you know, potentially being left out of that sort of move. So let's look at those three charts very quickly, just get a sense of where they're at. So again, you know, I often get the question, you know, the E-Trade yesterday looked fantastic, right? Breaking back above the 200-day, a big up day, an outside day going positive. Everything seems fine. We're now testing resistance. And then a buyout, you know, rumor comes out and completely changed the character of the chart. So, you know, when Wells Wilder was designing a lot of the technical indicators we use, he potentially did not look at equities, look more at commodities, because he didn't like all the gaps and all the company risks that you take on when you're looking at stocks. As an equity investor, you are naturally exposed to that sort of volatility that comes with the game. That's part of the excitement of it, I would imagine, but also part of the risk that you're taking on by buying individual stocks. But that's okay. The point of using charts after a day like this is to look at where we're at, look to the left, and see what key levels you may want to be aware of. So here we have a stock that's now traded down to the 50-day moving average. The RSI has come down just above the 40 level. These are traditional places in a healthy environment where a stock tends to find support. So seeing if that happens here on ETFC could be very interesting. Let's look at the other two that were involved in this discussion. Here is Ameritrade, TD Ameritrade, you know, a nice break above the 50 and then the huge gap up also on, you know, on the rumor. Now we're testing this resistance level. Noticeably, we opened up here 51.50, traded down on the day. And if you look at Schwab, you'll see a similar type of pattern. So both of these, a big gap up on the news, but as investors had a chance to digest it, came down a little bit. So the next day, the follow-through day on charts like that is really, really important because that tells you how people are sort of processing once they've gotten used to the idea of what happens with the chart. So that's sort of what we're seeing as a market recap today, looking at some of those themes, looking at some of the key charts. Next, I wanted to introduce the mystery chart. So as you know, this is a popular segment where we show you a chart. We cover up the tickers, cover up as much information as we can, have you guess what this is. So my question to all of you is, what is this security that I'm showing you? All I will tell you, this is a traded security in the US. It trades on a US exchange. This is the price, the daily price going back 2 years. And then this is that security relative to the S&P 500 total return basis. At the bottom, as you can see, beaten down sideways, potentially just starting to break to new 3-month relative high, which is kind of potentially compelling. So that is our mystery chart. Put any guesses that you have into the chat room. right on your StockCharts TV screen, and we'll come back to this later in the show, tell you what it is and why it's important. For our next segment, we actually have a Talking Technically segment. As you know, we have a great group of contributors, people like Arthur Hill and Greg Schnell, John Murphy, Martin Pring, and many, many others, really knowledgeable experts in technical analysis and charting and market behavior. Tom Bowley sat down with us recently and talked particularly about candlestick analysis and about reversal candlesticks. You will notice on my charts, I don't use a ton of candlesticks, but when I think of things shorter term, I absolutely use them. And I think of them because they're a great way of illustrating short-term supply and demand. We're going to hear from Tom Bowley, and then I'll come back and make some additional comments. So here's Tom Bowley on candlesticks.
Candlesticks are a great visual aid in identifying key reversal areas on a chart. Let's take a look first at Johnson & Johnson, J&J. If you look back to March, and then again in April, once again in early June, and then the latter part of July, you'll see clear uptrends in play, identified with these blue directional lines. At the end of each one of these uptrends, though, check out the red circles that highlight a bearish engulfing candle. Each of these 4 uptrends was ended with a bearish engulfing candle. These candles represent a gap higher from the prior day close and then selling throughout the day to completely engulf that prior day's buying. In all 4 of these examples, after these bearish engulfing candles printed, you can see the results. Moves to the downside, uptrends exhausted. On the flip side, we have hammers that can provide great support off of downtrends. And when they occur at prior support levels, they can be even more meaningful. In technical analysis, the more types of technical signals that you can combine, typically the stronger the signal. So in this case, off of the high back in September, Johnson & Johnson sold off for about the next 3 to 4 weeks. And at the very bottom here, you can see printed a hammer which tested 2 key areas of price support. So in addition to knowing that this was an area where buyers would likely return, we also had a reversing hammer candlestick on this decline, which adds to that probability of a reversal. Hammer candlesticks typically look like a hammer. You'll have an open near the high of the day. You will have an intraday move down below sometimes key support, a long tail showing some intraday weakness, and then a recovery late in the day to print the close, which is down close to the open, and that's what completes that hammer candlestick. So always use these candlesticks to potentially find some key areas where we look for major reversals on charts. Can be very useful to a short-term trader.
So that was Tom Bowley, good friend of StockCharts.com, talking about reversal candlesticks. And again, I often use candlesticks when I want to get a read on short-term supply and demand. So when I'm looking at the longer-term charts, the candle patterns are a little less interesting. But when you're looking at short-term dynamics, thinking about tactical moves in a stock that you're interested in, can't tell you how important it is to look at candle charts. You know, one of the things I would tell you, Royal Caribbean comes to mind as a great recent example of where you see when a stock hits support, when it sells off, you look for reversal candles when it hits a key support level. And more often than not, when you see those happen at a key support level and you see a reversal candlestick, ends up being a high probability reversal to the upside. I will tell you, when I studied for the CMT exams, the Chartered Market Technician, you have to learn all about technical analysis. 2 things that I used to study candle patterns. Number 1 was John Murphy's book about technical analysis of the financial markets, because he had all the pages that I made notes on, and then the StockCharts.com chart school. So if you're not familiar with some of those patterns that I was talking about, or that Tom in particular was talking about, check out Chart School for the articles on candlesticks. You'll get a lot of good information about how to use that as part of your discipline. We're going to take a quick commercial break. Be back with my friend Todd Sohn from Strategas. See you in a minute.
The Chart Watchers newsletter features expert technical commentary about the current market from some of the industry's leading technical analysts. See what's really happening in the markets through their eyes and gain an edge in your own investing. The newsletter is packed full of insightful and educational articles intended to help you become a better investor. Whether you are brand new to charting or a seasoned technical analyst, each edition will provide a wealth of informative content. It's the best way to stay informed on all the latest news, events, updates, and additions here at StockCharts.com. Whether it's a new feature or blog, an upcoming conference, or a special sale, you'll hear it first in the Chart Watchers newsletter.
Hello, everyone. Welcome back to the show. Thanks so much for joining us here every day on the final bar after the close. Thanks so much. I really appreciate it. I want to welcome on my guest, Todd Sohn from Strategas. Todd, good to hear from you, my friend, and thanks again for coming on the show. We appreciate it.
Thanks for having me, Dave. I appreciate it as well.
So you took the time to send a couple charts ahead of time. I really appreciate it. And talking about volatility, which is great because this has come up on the show a couple times in the last week or so. So I'd love for you to walk through your charts about low vol environments and what they mean. So the first chart, we're looking at the last 10 years or so. What are you seeing here?
Yeah, so for as much headline volatility we've had in the news, given the trade war or endless amounts of issues, right? Equity market volatility is actually in a historical extreme going back about 40 years. What the bottom panel here shows you is the average daily range on the S&P 500 over the last 20 days. So that's at about 54 basis points. And I think the most important part of this is that low volatility environments are associated with new cyclical upswings and a bull market, right? The most recent example being 2017. But even on this chart, you can go back to, say, 2013 or 2014. So as boring as the tape may be right now, we need to use this to our advantage that we are in a fresh leg higher.
It's really interesting, and it's funny. I find a lot of sort of novice users thinking about, the VIX, thinking about volatility, for example. At a low level, you immediately think that means it has to reverse up. But what you're showing here in 2017, for example, it was low and it stayed low for quite a while. Now, how does that compare to what you saw in the mid-90s? This is the second or early 90s. This is the second chart you sent us.
Yeah. So outside of your 1 or 2 day setbacks, these environments persist. And if we wanted to go back further in history, like we have here, look at the early to mid-90s, volatility decreasing as the early part of that decade went on. You started to hit those extremes in the 5th percentile of our observations in our database. And when you hit that, it's a signal that things are pretty good. The trend is well in firm hands, and that don't be too scared if you get these modest setbacks where you have, say, a VIX blow up on a 1 or 2 day period. That the broader market is still very firm. History is very much on our side here.
It's really interesting. Now, again, a lot of the conversation we've had with some of our guests recently is thinking about the U.S. versus global equities, how to relate the two of them together. Your third chart is dealing with ACWI, the All Country World Index. What are you seeing here in terms of where it's at relative to some key levels?
Yeah, so as we have this low vol environment, you may get a small setback, and I think this is a logical place that you have the ACWI, right? All global stocks right back to the January 2018 highs. Could you get a small setback? Of course, but I think what the big difference is in 2018 versus 2019 is that it's not just the U.S. You have markets like Japan and Europe and portions of EM actually rising here, whereas last year, as we all know, in the fourth quarter, it was just the U.S. going up. Well, you had a global equity bear market. So I think this is an important chart to watch in terms of levels. If you get the ACWI back to, say, $75, I'm more inclined to be buying that dip, and then eventually the market responds and you finally break over that 2018 high. It's tough for me not to see this as a new bullish upswing for global equities in terms of participation.
It's a really, really interesting long-term chart. And I love the long-term perspective here. It's, we always coach people. It's so easy to get caught up in the short-term movements. Here you're given a great long-term picture. I'm very curious with this last chart, looking at All Country World. If you're thinking a pullback makes sense because of resistance, thinking it would be viable if it gets down to 75. What does that mean about the U.S. versus global markets? Is that a signal to tilt more internationally than you would have otherwise? Is there some way that you would look at US versus non-US and make that call between the two? How do you think about, or how are you coaching your clients to think about that?
It is on my radar. I wonder if it's a little premature to say that US will give up leadership.
Right.
But at the very least, I have more to allocate to now. If I have X amount of dollars, I can move some of that out of the US now and into Europe and Japan and EM, and it'll be treated much better than it has been over the last, say, 18 months. I feel much more comfortable with that. The relative performance, though, is, I think, a question mark going forward.
Right.
That's the more difficult question, if the U.S. will ever actually give up this great leadership it's been.
Right. Now, going back to your first chart, just to wrap up, and thanks again. These are three really interesting charts. The very first one, looking at the S&P 500, obviously you're sort of talking through a pretty constructive take on equities. Looks like this sort of pattern and traditionally has led to stronger stocks. That's pretty decent. What would you see on this chart that would tell you that maybe that's not playing out? Is there some sort of key level or some signal for the S&P 500 that would tell you, okay, it's not going up anymore, this is a chance to get more defensive? Is there any particular line in the sand or signal that you'd be looking for here?
If you can't hold the 3,000 area, then I start to get a little worried. And I would also emphasize looking internally, right? We've had some signs of a cyclical rally here where industrials and banks have been leading. If those roll over again and we're back to the environment we were had for the last year and a half, then I get very nervous. And if you start to see staples and utilities and REITs catch a bid again, that would get me much more concerned, and I think would weigh on the S&P. And you're again back below 3,000. You're back into the range for most of the year. So keep that on guard, but also make sure you look at the components of what how the individual stocks are actually acting.
That your last comment there, Todd, is fantastic, and I appreciate this. The idea of thinking about the big picture, but then there's no replacement for the bottom-up work to really think about leadership and what's working and what isn't. Todd, thanks so much for joining us. Three really good charts and a really interesting take on the markets. Thanks for coming on the show, my friend.
My pleasure, Dave. Thanks a lot.
Folks, that was Todd Sohn from Strategas in New York. Thanks to him for joining us for sure. Really interesting take. Three really good charts. I really love having guests like Todd and so many others that we've been able to have talking through, getting just a look inside their process just a little bit can be so helpful, can help you out. Have you guessed what the mystery chart is? Any final guesses as we consider it? Let's see. XLV, healthcare, decent guess. And congratulations, you're absolutely 100% right. This is the healthcare ETF, ticker XLV. The reason why we are talking about this, and then we're going to talk a little bit about more about the chart patterns. The reason why this is so interesting, I found with sectors especially, what happens is you get really focused on a particular sector or group of sectors. For me right now, it's technology, which is essentially been vertical. It's financials breaking out of a 2-year base. Looks a lot like the ACWI chart that Todd just showed, right? This big sort of inverted head and shoulders that's potentially broken to new highs. And then the third one are sort of these defensive plays, utilities and real estate in particular. Do they continue to weaken here, or do they start to recover and people buy in on weakness? But what I did not mention, and I found that a lot of people focus on certain sectors and then other sectors are quarter off the radar. And things like energy will come out of nowhere and start doing really well. And you won't realize it until it's late because you forget to be paying attention to it. And a lot of those we have, like the RRG and the member dashboard, are designed to help you, minimize the chance that you're going to miss some of those signals. But having a good routine of going through these sectors is so important. If you look at the chart of the XLV, and this is a fine place to do it, we have this resistance level from last year in 2018, from September into October, again in December. This was the market low at the end of December, around Christmas Eve. You then had this nice recovery. Healthcare completely underperformed in the first quarter. I mean, it's absolutely brutal. And then bottomed out in mid-April on a relative and on an absolute basis. That was the low so far as it sort of rallied from there. Here we have sort of the wilderness where it's in a market performer, not really getting you much on either side, weaker rather than stronger, but not really a big move on a relative basis. But what's just starting to happen now is you've broken out above resistance around 94. You've come back and tested that successfully and now broken to new highs. Again, more highs today, intraday, intra-week, new weekly closing highs over the last couple weeks. And now what interests me more than anything else is a new 3-month relative high. And I spent a lot of time thinking about 3-month highs and lows, 65-day or 13-week highs and lows, because if a stock is able to do that, especially on a relative basis, that shows you that it's starting to build some momentum and starting to outperform or underperform others, depending on a relative high or low. So the fact that the XLV has broken to new highs at a time when other sectors are not doing so, the fact that it's breaking to a new 3-month relative high when other sectors are not doing so, tells me that it needs to be on my radar just a bit more than it probably is. Now, if you understand why that is happening, going back to Todd's really good point at the end of the interview there, talking about the value of looking bottom up and looking at individual stocks and groups and themes and seeing what you can pick out, go to the industry summary page and look at some of these sectors, and you'll find that there's a little bit of differentiation in terms of which types of stocks are doing better than others. And just looking at the quick previews, you can see things like biotech breaking to new highs, healthcare providers doing very well, medical equipment, more of a basing pattern that's now resolved to the upside, medical supplies breaking higher, pharmaceuticals may be one of the weaker ones. And a lot of the big names in there have not looked as attractive. And that's probably why it's a little less positive. So if you're not familiar with those groups and not familiar with those names, go to the industry summary page, click on one of those groups, sort it by market cap, sort it by scooter ranking, and see which stocks are actually moving that. But if healthcare is not on your radar yet, make a point and do so, because I think you'll find it's probably going to be some names you want to pay attention to. We are now going to wrap up with the 3 and 3 charts that you should have on your radar. If not yet, then boy, by now I hope it is. Number one, we did not talk a lot about fixed income today, and so I wanted to make one of the 3 and 3, the TLT. This is due to bond prices because it's very liquid, widely traded, good read on bond prices overall. Here we've had this consolidation pattern that broke down to the downside, then recovered. The TLT has now reclaimed the 50-day. But I found a lot of people starting to get really excited about bonds because they've been rallying over the last week, while stocks overall now starting to sell off for a couple of days. I think it's a little early to get too excited about that as a huge rotation. It's just the beginning of it. It's more of a corrective move at this point. Now, what would tell you that the bond price rally, the bond rally has legs? A couple of things. Number one, I would want to see it continue through beyond the 50-day, which it has not quite done. Number two, break above resistance around 140, 150. Number three, break above this trend line resistance, taking the highs from August and October. 1, 2, 3, if those three things happen, I think you can legitimately say we've now rotated from a pattern of lower highs, lower lows to higher highs, potentially higher lows. That would tell me bond prices are going higher. So that's the chart to watch, in my opinion. The second one is looking at some breadth, and the next two we're going to look at breadth in U.S. equities. So this is the new highs and new lows on the S&P 500 at the bottom, and the New York Stock Exchange next one up. And one of the things that we've seen a number of times as the market gets heated is you start to see this divergence with the market going higher, but every time the market pushes to new highs, less and less stocks actually going to new highs as well. And there's a lot of reasons why that could happen based on all the individual stocks, leadership, and themes, but it's worth noting that that pattern has reemerged, and you have higher highs in the month of November, but both of these breadth measures are actually sloping downwards, telling you less and less stocks breaking to new 52-week highs. The third one is a little more shorter term. This is the McClellan oscillator created by Tom McClellan, who's one of our contributors. His parents, Sherman McClellan, is known for pioneering this idea of a new way of looking at breadth. Essentially looks at advancers, decliners, but smooths it out with exponential moving averages. You can go to the chart school page if you're not familiar with it. Two things to look for. Number one, when the McClellan oscillator is below zero, that tends to mean that the short-term momentum, short-term breadth is weaker rather than stronger. That happened a couple weeks ago. We've now followed through to the downside, a new low in the McClellan oscillator, telling you there's some internal weakness. The second one is look at when it's really extended, which has not happened yet. But if and when it comes down, you look at when the McClellan oscillator is relatively low, and you'll see that that lines up really well with market lows. So overall, tilting more negative than positive will be interesting to see if the McClellan oscillator remains at those muted levels. That is our show for today on a Thursday afternoon. Thank you so much for joining us today and every day on the Final Bar, every day 4 o'clock Eastern on StockCharts TV. You can get our email, thefinalbar@stockcharts.com, or look us up on Twitter @FinalBarSCTV. We'll be doing a mailbag session tomorrow. So if you have any questions on what we talked about this week, get them into me today so we'll make sure we review them on the show. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night.